Gold prices are going to soar and they could even reach $3,000 in 2023. Now, this is a bold prediction by Saxo Bank, and if we investigate further, it really isn't a crazy forecast. Now, it's obvious that I am a gold bull, but since inflation started to soar around 7%, I was calling for lower prices because fundamentals for gold were truly very bleak. But things are starting to materially change, and we are not just talking about the rate hikes by the Federal Reserve. There are big geopolitical moves happening. They are setting up the perfect storm for gold prices to fly up in price. Now, I'm not sure if we'll hit $3,000 by 2023, but I really won't be surprised at $2,000 gold next year. And if we look at gold's performance in 2022, it is near flat and was actually positive just a few days ago. In contrast, we have the stock market crashing by 16%, which tells you something materially has changed, guys. Rising rates are supposed to crush both gold and the S&P. Investors should leave gold because the risk-free rate is higher, while higher rates will crush companies and crash stock prices, right? But gold is still surviving and holding strong and hasn't really been affected much this entire year. In fact, it might just be the best performing asset in 2022. And it seems that we have an incredible case building for gold to explode, which starts with the Federal Reserve's rate hikes and inflation. And according to Ole Hansen, the head of Saxo Bank's commodity strategy, 2023 is the year that the market finally discovers that inflation is set to remain ablaze for the foreseeable future, right? Sure, inflation is coming down. We have November CPI dropping to under 7.1%, but that is still insanely high. If we just have 3 years of inflation at that level, you will lose almost 20% of your purchasing power. That's how stupidly high it is still. Now, he believes that people are going to lose faith that the Federal Reserve can keep inflation under control. And as we all know, the longer inflation rages on, people are going to wake up and they will head towards gold sooner or later. But what Hansen said next tells us there's a bigger game going on. He mentioned how a war economy is inflationary, and we expect investors to realize in 2023 that central banks are not going to be able to keep inflation under control. Basically, we have two wars going on. One is the conflict in Ukraine, but the bigger one is the economic war going on between the West and the East, between the United States and oil producers like OPEC and Russia. And this is what we have to break down today because the future is bleak for fiat currencies and the stock market, but it's looking real bright for gold. Now, first, let's understand why inflation is going to stay high, even though it is slowly creeping down. It is a good thing for gold to see inflation slowly taper down instead of staying high. Now, the problem with the markets is that everyone is just focused on the Federal Reserve and no longer on fundamentals, right? We are on a hype train, and how the market moves depends on the inflation rate. And it is this inflation number that will control the Federal Reserve rate hikes. And that's why even though inflation has soared to all-time highs, gold kept crashing down. And that's because the higher inflation goes, the more the market anticipates the Fed will continue to hike rates. Now, inflation hits 9%, that just means bigger rate hikes are coming, and higher rates are bearish for gold. But they just don't understand that inflation itself at that crazy level is the problem, right? However, people are starting to realize the truth. Now, Powell came out yesterday in the FOMC meeting highlighting how terrible inflation really is, right? He said, "We understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal." So it sounds like more rate hikes are coming, but I want us to really look at the Federal Reserve's actions more than Powell's words because he's still trying to balance the economy with price stability. He's still trying to attempt the soft landing fantasy, and that's why he just increased the Fed funds rate by only 50 basis points in December. If he's really serious about inflation fighting, the Fed funds will easily be above 7% today. What we have is the Federal Reserve coming towards a pause probably sometime in early or mid 2023. Powell has said before that he wants to get interest rates above inflation. He wants real interest rates to be positive. But he's going to count on inflation falling down below interest rates and not rates going above inflation. Now, there's a big difference here. And this means the Fed is probably going to take a pause after the next 2 or 3 hikes. And those hikes are going to be milder at probably 25 or 50 basis points each. And if you look at the core inflation, it is starting to stabilize at 6.4%. And we have the Fed funds now at 4.5%. The gap is narrowing and the Fed doesn't need to hike much more. I believe they will hike to at least 5% and then let inflation fall down gradually below interest rates. Now, I've been calling for 5% for the longest time, and I'm going to stick with that prediction. Now, this Fed pause is likely going to be bullish for gold. Inflation is going to come down in a way that will signal fewer rate hikes, but as it falls slowly, it will remind people that we are still in an inflation hell. And as people still have some breathing room to spend, money is going to flow more into gold. But things are going to be quite different in the stock market, right? Because if the Fed is going to let inflation slowly taper off down 0.5% a month or so, this means rates are going to stay high. Remember that there's always a lag effect of monetary policy, and we're already seeing growth starting to slow. Now, Powell, he made three critical statements telling us that even the Federal Reserve is expecting a recession to come. Now, statement number one, growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. So Powell is telling us that an earnings recession is coming. Many top CEOs, including Jamie Dimon of JP Morgan, have been telling us that consumer dollars are evaporating and inflation is going to destroy the economy. Now, statement number two, activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates, which makes total sense. US housing demand is starting to calm down, and we can see new home starts, especially family homes, crashing month after month. People just can't afford the higher mortgages, guys, especially when they have to lock in 30-year mortgages at over 6%, nearing 7, and that is totally insane. So what we have is people abandoning home ownership and spending more on rent. And statement number three, higher interest rates and slower output growth is also appear to be weighing on business fixed investment. If we look at the borrowing rates for companies, they are still more than double what it was just 12 months back. US corporate bonds are pegged around 5.1%, and good luck if you're a triple B or triple C company. You can just forget about raising money, right? So what we have is a situation of the economy slipping into recession and stock prices still not reflecting that. The Shiller P ratio is at 29, which is still crazy high, showing the market is still pricing in high multiples, right? As though interest rates are still near 0%. And when this reverses and reality hits, a lot of money is going to exit equities and likely rush into gold. Remember, inflation is still sky high, and even if it averages around 4 or 5% in 2023, it is still eroding purchasing power. When people realize inflation is prolonged and the markets are collapsing, they'll be forced to move towards a true store of value, guys. But let's talk about geopolitics for a second, because all these interest rates and recession talk, they're just one half of the equation. And we have Saxo Bank also calling for the US dollar to lose relevance in 2023 and beyond. China, India, and OPEC are going to slowly de-dollarize. Now, gold is not only an inflation hedge, it is an asset without counterparty risk. Physical gold is free from American sanctions, and we're going to see more countries get tired of the dollar's weaponization. And according to their strategies, Raymond Wong, a natural solution for China and its many trading partners, particularly energy and other commodity exporters, would be to find a new non-national currency reserve asset upon which to trade. And it's very likely this could involve gold. Now, there are a ton of signs that gold is going to come back in a significant way, right? Just like how the US has weaponized the dollar at interest rates, we could very well see the East, like China and even Russia, weaponize gold in return. Now, just recently, China reported an increase in their gold reserves, right? They added 32 tons of gold, and this disclosure came 3 years after their last reported increase in 2019. And we all know China has been buying much more gold than that, and it serves no benefit to announce a huge increase, right? When you're accumulating gold or any other asset, you want to be buying when prices are low. You want to be buying when prices are cheap. And that's why I believe China's 32-ton announcement is a battle cry to the world. They are sending a message. They are announcing that they have a bigger agenda with gold, and it won't surprise me if it is a gold-backed currency, guys. And let's also not forget that central banks around the world are also aggressively buying gold. Global central bank gold reserves are back to the mid-1970s level, and they bought over 400 tons in just Q3 this year alone. That's a massive amount of gold, because they know the end game, right? Fiat currencies, they are dying, and as the dollar loses its reserve status, a lot of things can go wrong. And the US could impose financial sanctions on countries like China, or maybe the EU manages to successfully confiscate Russian assets, and all these events are pushing countries towards stockpiling more gold. But here's the interesting thing. we have Goldman Sachs coming out saying that gold will outperform Bitcoin in the long term. And we have to talk about this. Like how I believe things has materially changed for gold, the situation has shifted for Bitcoin as well, and not in a good way. Now, the problem with Bitcoin is that it doesn't have any practical real world use compared to gold, and it has crashed over 60% this year as rates went up. So we can safely say it isn't a stable store of value. And unlike gold, Bitcoin can't be used in industry or made into jewelry. It is stuck in the digital realm. And this is where things are gonna get very, very tricky. And the big monster coming for Bitcoin is regulation. And the SEC is gonna clamp down hard on cryptocurrencies because now is the best time to slap cryptos with standards and restrictions. And we have FTX and SBF to tank for that. And the first problem is the issue with CBDCs. Now, every country in the world will eventually launch their own digital currency. The Fed is experimenting with theirs, and once the digital dollar comes out, it is likely they won't tolerate Bitcoin as a competing currency. And I think this is one headwind that crypto bros they are just refusing to see. If the government forces people to pay taxes or buy real estate, for example, using the digital dollar, your Bitcoin will have to be converted to the CBDC to buy stuff. Your physical body, it exists on the material plane, not the digital realm. And because CBDCs are programmable money, the Fed can just write a line of code that prevents any swap from the digital dollar to Bitcoin and vice versa, right? It's a real serious tail risk that could crush cryptos. And this is why central banks they are stacking gold and not cryptos. They don't want to lose control of their own currency, and they also know cryptos have counterparty risk, and that is against other countries' CBDC. So for example, let's say you're Australia's central bank and you hold Bitcoin, and one day the Federal Reserve doesn't allow Bitcoin to be swapped for the digital dollar, then Australia's stash of Bitcoin is now less valuable, right? They can't be swapped to buy goods and services in America or to buy US treasuries. And this is why Goldman favors gold rather than Bitcoin. And as Jeff Curry puts it, the development of real use cases is also crucial to reducing Bitcoin's volatility, but is by no means guaranteed and may take a long time to play out. Bitcoin just doesn't have any meaningful utility yet, and when a big diversification comes, gold will win over Bitcoin. And this is why gold will likely stay strong in 2023. We shouldn't forget that there's always the chance the Federal Reserve pivots early. Powell could lose his mind and start printing money all over again, right? And this is what Saxo Bank is also factoring into their $3,000 gold forecast. They believe that the Fed is expected to stop hiking rates in early 2023, and if a recession comes, central banks will cut rates, print, and flood the economy with liquidity. And this is why I've been buying physical gold over the past 12 months as well. Even as prices crash, I've been still picking up more ounces. And here's the thing, guys, physical premiums for gold, they have gone up. Just a while back in Singapore, a 1 ounce gold coin or bar was trading at around 3% premium, and now it has gone up to 4 or 5 or even 6% easily. And this tells me people on the street, they are waking up, and there's going to be more momentum heading into gold. And as always, I'm still a buyer because I don't trust the Fed to do the right thing. So let me know what you think in the comments below. Will 2023 be a good year for gold, or will the Federal Reserve keep hiking rates and crush everything? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.